A deal worth $75 billion just collapsed, and the shockwaves are hitting both sides of the border. A massive infrastructure project between the United States and Canada, the largest bilateral infrastructure agreement ever proposed, is now dead. And according to some of the most respected voices in global finance, the consequences may last for generations. The project was called the North American Gateway Initiative. For 4 years, it was quietly negotiated by officials, engineers, and investors from both countries. The plan was simple but incredibly ambitious. Rebuild the entire U.S.-Canada trade corridor for the 21st century. New bridges, expanded tunnel high-speed freight rail, modern border crossings, integrated energy grids, and a digital customs system designed to move goods across the border faster than anywhere else on Earth. The total cost was estimated at $75 billion over 15 years. Canada was prepared to invest $45 billion of that total. The United States would invest $30 billion. Together, the project was expected to create more than 400,000 American jobs and generate over $120 billion in new annual trade capacity once completed. To put that in perspective, for every dollar the United States invested, economists estimated the American economy would gain $4 in return. But now the entire plan has been suspended indefinitely. Canada walked away, and the man who made that decision was Prime Minister Mark Carney. In a short statement delivered in Ottawa, Carney announced that the North American Gateway Initiative was being halted because the current economic relationship between the two countries had become too unstable for a long-term infrastructure investment. His words were calm, but the message was devastating. Canada no longer considers the United States a predictable investment partner. That single sentence changed everything, because infrastructure projects of this scale are built on trust. Bridges and rail lines take decades to plan and build. Investors commit billions of dollars based on the assumption that the political relationship between the countries involved will remain stable for years. But according to Canadian officials, that stability no longer exists. The reason? The ongoing trade conflict between Washington and Ottawa. Tariffs imposed on Canadian exports, combined with retaliatory measures from Canada, began shrinking trade volumes between the two countries. And that created a serious problem for the Gateway Initiative. The financial model behind the project depended on trade continuing to grow. More trucks, more freight trains, more cargo moving across the border. But tariffs were doing the opposite. Trade volumes were beginning to contract. And once that happened, the math behind the entire investment started to fall apart. Canadian pension funds that had committed billions to the project were legally required to reconsider their investments. By the time the announcement came, much of the private capital backing the Canadian side had already started pulling out. But there was another reason behind the decision: a strategic shift. Instead of investing $45 billion into infrastructure that connects Canada to the United States, Ottawa has started redirecting that money toward projects that connect Canada to the rest of the world. New Pacific trade terminals in Vancouver and Prince Rupert, expanded port facilities designed to handle cargo from Asia, modernized Atlantic ports in Halifax serving European trade, and new rail corridors moving goods across Canada without relying on U.S. transit routes. The investment didn't disappear. It simply moved somewhere else, somewhere that no longer depends on the United States. When legendary investor Warren Buffett spoke publicly about the collapse of the deal, his reaction surprised many people. Buffett has spent decades analyzing economic policy, but this time his tone wasn't analytical. It was emotional. He called the Gateway Initiative the single most significant infrastructure opportunity America had in the 21st century. Not because of its cost, but because of what it would have built. A fully integrated trade corridor stretching from Chicago to Toronto. A network of bridges, rail lines, ports, and digital logistics systems that would have made North America the most efficient trading region on the planet. And now that opportunity is gone. Buffett explained that infrastructure is different from most economic investments. When a country loses a trade agreement, it can negotiate a new one. When it loses a factory, it can build another. But when an opportunity to build massive infrastructure disappears, it rarely comes back. The capital moves somewhere else, the engineering teams move somewhere else, and the window of political cooperation closes. According to Buffett, that's exactly what just happened. Even companies inside Berkshire Hathaway had positioned themselves to participate in the project. BNSF Railway expected to benefit from the Chicago, Detroit, Toronto freight corridor. Construction material companies owned by Berkshire were preparing for bids on steel, insulation, and concrete. Energy subsidiaries were planning to participate in new cross-border power infrastructure. Now all of that potential business has vanished. But the most important consequence isn't financial. It's strategic. America's border infrastructure with Canada is already aging. Some of the busiest commercial bridges between the two countries were built nearly a century ago. The Ambassador Bridge between Detroit and Windsor opened in 1929. The Peace Bridge connecting Buffalo and Fort Erie opened in 1927. Several major crossings were designed long before modern freight logistics even existed. The Gateway Initiative was supposed to replace and modernize those systems. Without it, many of those aging structures will remain the backbone of North American trade for decades. While the United States struggles with outdated infrastructure, other regions of the world are investing heavily in new trade networks. China is building massive logistics corridors through its Belt and Road Initiative. The European Union is investing hundreds of billions into high-speed rail and automated ports. Southeast Asia is rapidly expanding its own trade infrastructure. Every year those networks become faster and more efficient. And every year the gap between them and the United States grows larger. That's why Buffett warned that the true cost of losing the Gateway Initiative will not be measured in years. It will be measured in generations. Because the infrastructure that wasn't built today may never be built at all. And the competitive advantage that North America could have gained may now belong to someone else. The most striking part of this story is how quickly everything unraveled. After Canada suspended the deal, officials in Washington attempted to reopen negotiations. Multiple calls were placed to Ottawa, diplomatic delegations were sent, but Canadian officials made it clear that the decision was final. For now, the project is finished. The capital has been redirected. The teams have moved on. And the blueprint for the most ambitious North American infrastructure project of the century is sitting on a shelf, unbuilt. The question now isn't whether the Gateway Initiative will return. The question is whether the United States and Canada will ever rebuild the level of trust required to attempt something like it again, because the future of North American trade may depend on it.